Hi, in this video I'd like to explain a bit about macroeconomic variables, especially since a lot of things like interest rates and RBI policy etc. are talked about in the media, and many times it is difficult to understand how certain things happen. So let me give you a very simple way of looking at it. One is that the government and the central bank, and this is true not just of India but of every country in the world, what would they ideally want? Ideally, high GDP growth, you would want low inflation, you would want low unemployment, you would want low interest rates, and you want a strong currency. So you want all these five things. But think about it this way, that as far as managing macroeconomics is concerned, there is a box in which they can fit in maybe three things. But now you have five factors you want to control. So if you try to cram all these five factors into this box, something will pop out. So it depends on how you are prioritizing as to which is the variable you want to let go, in a sense. And I remember making a video around the end of 2021, beginning of 2022, when currency was not on anyone's mind because Rupee had been in this very smooth range for a long time, between roughly 73 and 75 and a half. And I had predicted then that Rupee was ready to go down. So this was about 3.5 years ago, and since then, as you know, the Rupee has moved all the way up to about 88. But again, this is not even giving you the full picture, because you're looking at the Rupee only vis-a-vis the US dollar. So if you look at today in 2025, I'm making this video beginning of August. So if you look at it from January to now, it looks that the Rupee has depreciated only 2.2% against the US dollar. But if you look at Rupee against the Euro or the Swiss Franc, it has depreciated almost 15% in this year. And if you look at Rupee versus the pound, it's about 9%, so a lot more than what is apparent from just the US dollar INR rate, because the dollar has depreciated against a lot of the other currencies, which for us is masking the real depreciation in the Rupee when you look at multiple currencies together. So which also brings me to a related factor, which is that this is the reason that you should look at global diversification very seriously. Even from the time I started working, the Rupee has depreciated 90%. I mean, it was 12 rupees to a dollar when I started working. Even from 10 years ago, the Rupee has depreciated almost 40%. 10 years ago, it was roughly around 63 rupees. So when you are thinking of long-term goals, if you do not look at this currency aspect, you will see your portfolio actually coming down in real terms. So when you are looking at goals which are 10, 20, 30 years ago, later, you cannot forget this part. If you're looking at goals a few decades later, you can be assured that the Rupee will depreciate over that period of time. Besides the fact that in any case, we all know that old adage that don't put all your eggs in one basket. So this is the time to diversify. And since this is a cause for me that I think Indians do not diversify globally, and they should, First Global gives you access to global markets, not just US markets, but all countries, all asset classes, with something that starts only at $10,000. Today it is of course 8.8 lakh rupees. 10 years ago it would have been 6.3 lakh rupees, but get started on that. But also coming back to where we started on the macro side, one other thing which I would like to point out, the reason also there is additional pressure on the currency, and the reason why probably the RBI is not that keen to cut interest rates, which they did not speak about, but it clearly has to be a consideration, that now the interest rate differential between what the interest rates in the West are and what it is in India is at historic lows. So today, if you look at a 10-year bond in the US and a 10-year bond in India, the differential in interest rates is only about 2% or sometimes 2.2%, meaning In India, you will earn 2.2 percent points more than what you would. So roughly, if it is 4.4 in the US, in India you might earn 6.6 or 6.4, in that range. So this is a historic low. For example, pre-COVID, the differential between us and the US interest rates, that is US interest rates were lower than Indian interest rates by about 5.5%. At certain peaks, they were lower by 7% points. And now it's only 2% points. So you would know that when interest rates are relatively high in an economy, more money comes to that economy. So right now, relatively, Indian interest rates are extremely low compared to the history. So that's also a reason why it would be difficult to attract money into the country. So all these things, of course, are playing in the background also of what RBI will do or not do in cutting interest rates. But I would like to therefore reiterate that while I am not negative on the Indian market in any sense, but in your asset allocation, you cannot confine yourself only to Indian assets. You have to look global, and we do offer a very easy way to have a true global exposure, not just an exposure to 6 or 7 US stocks or only just to US indexes. Most other products in the market will take you there because they do not have expertise beyond that. But First Global was not just the first Indian, we were the first Asian firm to go west, to go to UK, US from 1999. So other than the Japanese, no other Asian firm had gone west. So we have been following those economies, those countries, even the major stocks in China and Japan for over 25 years. So that's why we can provide something that gives you a more tactical reallocation according to what circumstances are. For example, since January, we have been underweight US in our global funds and global portfolios. We've been overweight Europe, we've been overweight China, we've been slightly overweight India. So all those calls keep changing over a period of time, but you have to have the expertise in order to do any of that. So I've covered a lot in this video, longer than usual, which is about how to think about macroeconomics, as also why that leads you into the absolute necessity of diversifying your portfolio globally. So if you have comments, if you have questions that you would like us to address, do let us know.